I'm not buying Mapletree Logistics Trust yet, but today we'll discuss why is it so popular. If you want to know REIT deeper, you have to study the entire industry, correct? So that's what we're doing for today's exercise. Let me pull up the 4 biggest logistics REITs in Singapore. There are Frasers Logistics Trust, there are Mapletree Logistics Trust, AIMS APAC REIT, and ESR Logos REIT. All 4 are specialized in the logistics sector. If you see over in this chart, you realize that ESR's performance has been terrible, correct? So without deep diving too far, we can eliminate them from today's discussion. Then in third place is FLCT, which has lost about 13% in the last 5 years. Most of their assets are in Australia, and gradually, from what I read, they are migrating the focus towards Europe and UK. They also have a lot of assets in Germany. I'll cover them with an interesting point towards the end of this video. And in second place, we have AIMS APAC REIT. Now this is the light blue line that you see is pretty flattish, correct? And the AIMS REIT, it really looks like a bond in terms of performance. And when we look in terms of the DPU growth, you would realize that it's also been pretty flat along the years. It's trended up from 10 cents to 11 cents and then trended downwards back towards 10 cents and now 9.5 cents. The latest at 9.36 cents only. This is even lower than in financial 2011. So in some years where its yield was 7 to 8% previously, which is higher than the yield currently for AIMS APAC REIT, I'm a bit surprised why share price hasn't sold down for this particular REIT itself. Many times on the channel, I've suggested we want DPU growth as investors, because when we invest in REITs, we don't want it to be like bonds that just pay us back and then capital come back. More than that, we want to be paid a compounding growth in terms of your dividends. Then we start to benefit also as shareholders, and that's where your share price will actually start to skyrocket. So let's narrow the focus to year-to-date performance using FLCT, Mapletree Logistics Trust, and AIMS APAC REIT. We would realize again that AIMS APAC REIT is pretty flattish again. Frasers Logistics Trust has lost 13%, but Mapletree Logistics has lost way more at 20+%. They will be the focus for today. And let me show you the 10-year performance for Mapletree Logistics Trust in terms of the DPU. Ta-da! As what I suggested, if DPU grows, that's where you benefit as a shareholder, correct? Your $1 is now giving you more and more returns. And Mapletree Logistics Trust has delivered that, especially since financial 17 and 18. I've looked in the books and realized at each of the subsequent years, there was acquisitions done. There were big scale acquisitions done, and in financial 2021-2022, there was more than just acquisition but also the drop in interest. That is of course the COVID related crash. That proceeded on for a subsequent year, but in today's climate, we would realize the interest cost is climbing back up already. And that is something I would like to highlight to you in a quick while. But let me show you some proof again that there were big acquisitions along the years. Judging by the asset base, you would see that in financial 2018-19, it was only $8 million of assets. But in 2 quick years, they have grown it to $11.2 billion. Then right now, it stands at 13 plus billion. So the one which I boxed up is financial 2020-21. It is mentioned, just to bring you back a bit in time, at that point of time, Mapletree Logistics Trust actually bought from its parent, China, Malaysia, Vietnam Logistics Properties. 9 of them in total, and they've one-shot acquired the 50% interest in 15 properties in China. Total deal size $1.09 billion. As you can guess, China properties has become MLT's key focus, and that's something you need to keep close to heart, especially if you want to invest in them. Right now, Hong Kong and China assets are worth about 41% in the total AUM, represented by the green and red boxes. However, in terms of gross revenue, they are not contributing that much. It's mainly Singapore as highlighted in the dark blue column. Now let's look at the books over the last 4 quarters to give you a complete picture. The first thing to look at is the debt. Upcoming, what is going to be committed. As what we can see, for the coming year, there's only 5% that needs refinancing. Not a big problem. But when I did this study, I realized something. In this map itself, you'll see a lot of purple columns, correct? And that's actually Japanese yen loans. Currently, Japanese yen loans account to 23% of total borrowings, whereas Japanese properties account to only 14.5% of assets. In my layman terms, this has to be some forex risk, correct? They are taking more Japanese loans that is in excess of their Japanese assets already. And I guess this strategy is just to keep interest costs low. But again, when you have forex risk, if Japanese yen skyrocket up backwards, that can cause certain forex losses. My guess is also that's why Mapletree Logistics Trust reports an interest cost of only 2.7% only. You would see that when we map out first, second, third, fourth quarter in a spreadsheet like that, the total borrowing cost has been inching up very slightly, way lower than many REITs we've covered on this channel. Again, the reason could be because of Japanese yen. Actually, Chinese loans are also much cheaper right now as compared to US loans and Sing dollar loans. From this table, the second part I'd like to highlight to you is that the DPU has been sliding over the last 4 quarters. In first quarter, it was 2.271 cents and it has slid down all the way to 2.211 cents for fourth quarter financial 2324. Actually, the gross revenue has dropped quite a bit in the latest report. The reasons? Lower contribution from China and currency weakness in Japanese yen, Chinese yuan, Malaysian ringgit and Korean won. And when you have properties listed overseas, when you bring back that income, if it's not hedged, you would realize that in Sing dollar wise, it's a bit lesser. That is the strength and weakness of Mapletree Logistics Trust, which has a lot of assets overseas. But if we look at the year-to-date share price comparison between these 3 REITs, Mapletree Logistics Trust share price dropped that much, 20% in year-to-date performance. The weird part is FLCT actually did way worse in terms of net property income, dropping almost 10%. FLCT focuses on Australian and Germany logistics assets again, and the share price hasn't reflected as much gloom as MLT's. With that, maybe I can come up with a theory. Maybe it's actually this. If we look in terms of lease expiry profile, we would realize that Mapletree Logistics Trust has quite a lot of lease expiring in China. That is the green bar over there, reflecting 13.2%. Now, China is a key focus where it wants to grow towards, so they are not letting up on that space. You as an investor will be very comfortable with it. It's mentioned over here that Chinese logistics markets face leasing pressure in 2022 primarily due to lower consumer demand and an increase in new supply of warehouse space. The compounded annual growth rate of square area is at 20.8%. And that's why the overall vacancy rate in China has risen to 15.1%. Wow. So there has to be crazy competition in the China logistics side, correct? Even though there are big players like JD.com and Cainiao as Mapletree Logistics Trust customer, I guess with oversupply, there will be vacancies and demand for rental to be revised downwards. Let me know in the comment section whether you agree with the analysis. And as always, smash a like, smash the subscribe, especially if you like content like this that helps you in your financial journey. And I'd like to end off with this. As a logistics REIT itself, Mapletree Logistics Trust is currently giving 6.6% in terms of dividend yield. If we were to compare just a couple of years ago when it was $1.25, it was already giving 6.35% in terms of dividend yield back in financial 2018-2019. Does this mean that there's a little bit of buffer? Even if China earnings drop, not too big a worry, then the question will naturally flip. What would the drop in terms of DPU really be? I dug around for analyst report and found something by DBS Research. They have mentioned this year's DPU, which is 2024, was enhanced by divestment gains. Likelihood it can't be repeated, correct? And what they have forecasted for 2025 is only 8.35 cents of DPU. That means actually almost a 7% drop based on the headwinds in China as well as some increment in borrowing costs. Wow, that really seems quite severe, and let me know again whether you agree with this projection or not. I guess a lot of whether you should buy Mapletree Logistics Trust hinges on whether you agree with this kind of gloomy outlook or you believe that China e-commerce will pick up very quickly and that the assets over there will be the shining light that Mapletree Logistics Trust can ride out with. Thank you for watching right at the very end, and as always, let me know your questions in the comment sections. And I'll see you in this previous video which touches on REITs or so. Maybe it can help you further your horizon on what to invest on. With that, that's all from me. I'll see you there. Take care as always. Goodbye.